Hey everyone, it is Sunday night and normally we are not at work, but today we are because Eric Jackson, who was supposed to come on Monday, had a last minute flight to catch. So in the span of 2 hours, we somehow got everybody out of bed and into our studio so we could film a conversation with the man who is leading what he calls an army of investors to revive a company called Opendoor Technologies. And Eric Jackson was actually the first guest we had on our podcast. And if you listen to that, you know that he was no stranger to activist investing, mobilizing retail. He's been doing it for decades. He first started with Yahoo back in the day. This time, it feels a little bit different. He's using technology. He's campaigning in front of Drake's door. And he's seeing results. The stock Opendoor is up more than 700% since he disclosed he's back investing in the stock this summer. The former CEO out, largely because of Jackson's criticism. They poached the Shopify executive to become the new CEO. The founders of Opendoor are now back on the board, and Jackson's got a new idea, Better Home and Finance, that he says is the Shopify of mortgages, and you won't even believe his price target. I had to ask him twice to make sure I was hearing him. But we also get a sense of just the journey he's been on, the struggles that he's had as a fund manager, and what it feels like to be leading this army of investors really around the world. So let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Eric Jackson, returning to the podcast. Thank you so much for being with us.
Great to be here.
My first question is, where are you flying tomorrow?
New York City. This is, sorry, for the last minute move. Here.
Let's start with the apology because we're filming on a Sunday night and we don't typically do that. We got 2 hours notice. But we're doing it because I feel like this is how fast your life is moving now. You were my very first guest on the podcast in January, and you actually didn't like Opendoor. You'd sold it. And then
good memory.
Yeah, I never forget, Eric. And then, this summer you sort of became Mr. Opendoor. So I'd love to just know what have these last couple of months been like for you?
Well, when I was here in January with you, I was trying to get good performance from my hedge fund. And I had this little AI team that of about 6 guys working away on all different kinds of AI models. And sometimes it felt like, drilling for oil, where you just and you hit a lot of dry wells and you're like, what is going on here? Because they were building models for earnings events. Like, is Apple going to beat its earnings, call this quarter and all this? They were building option models. They were building crypto models. They were building technical models, fundamental models, and all this kind of stuff. And they were sort of, a lot of spaghetti was getting thrown at the wall. And I was feeling like, okay, we've had mixed results. Some of this worked, some of it hasn't worked. Probably the biggest hits were that we picked Carvana really early on. That was one of the first models 2 years ago when we were first kind of getting the AI model kind of up and running, the very first iteration.
So you can't just like type in and say, do more of that AI model.
I mean, it seemed promising. Like the one difficulty we were having with that particular model that flagged Carvana was that it didn't tell us necessarily when to get out of a position. And Carvana was particularly volatile. And so I was sort of thinking that was a bug in the AI model, and we needed to improve the AI model because the stock had we got in, the model flagged it at $11. This is a stock that went from $400 to $3.50. And now it's come all the way back to $400. Okay. And our model flagged it at 11. To get into it. And at first I didn't believe it because you hear about all these things like, oh, the AI model is hallucinating and all this kind of stuff. And so like the very first model out of the chute, the engineers are like, yeah, your number 2 position should be Carvana. Like you got to go all in on Carvana. And I was like, are you sure? Like seems like pretty, radical because I know, it had obviously dropped so much, even though I knew the company and I knew some of the management team. So we checked it. The guy came back a week later, said, absolutely, you got to get back in this. By then it was $15 from 11 in a week. And so I did get in. But one thing and obviously it's done really well since, but it was super volatile. So between $15 and probably $200, it had 3 different times where it pulled back between 25% and in one case, I think 65%, like a 65% drawdown.
You are like, you invest in some of these, like you're looking for these kind of 10 baggers. So did that bother you? Did that create a little bit of doubt in the approach you were taking?
For sure. I mean, like it's like with Opendoor, like people get mad at me if the thing pulls back from like $10 to $9. I get all these like emails like, oh, you're an idiot. You got to tweet more. You got to do this. You got to do that. Or like, you were wrong. I got in at the high and why, and all this stuff. Imagine like if a 65% drawdown, like imagine if it went from $10 to like whatever, $4 or something. Like that's hard to sit with. And so I thought there was a problem with the AI model. And I was like, are you sure? Like it seemed to get us into this position, but maybe it's not doing such a good job of getting out. What I guess I've come to learn with some of these, not just 10 baggers, because Carvana's turned out to be a 100 bagger, is like the problem is it's sort of like a feature and not a bug, that these types of stocks and, like growth tech stocks in general just are prone to big drawdowns.
So are you still all in on the approach of using AI for stock selection? Because it sounded like you were in a moment where you're like, I'm not so sure.
Well, so what I told the guys in probably a month or 2 after we had our first podcast here was, okay, we don't have time to work on 8 models. Like, let's work on our most promising 2 models, which were crypto and this sort of 100 bagger idea. And so so for the hedge fund, let's go all in on the 100 baggers because we had some ideas around doing a treasury company for the crypto models, which we can talk about later. And so like, let's try to find more Carvanas. That was like the mantra in like March of this year. And so we had 2 right out of the gate, IREN and CIFR that we checked, and the models seemed to validate. And I started talking about them and tweeting about them publicly. And I would describe them as the next Carvanas. And the funny thing was that I noticed like an immediate a response from Twitter, from just people who heard that phrase. Like they were drawn in. They wanted to know, like, and I'd often hear, I missed Carvana. Now I'm not going to miss it again. So this is the next Carvana? Like, tell me more. And so the Twitter followers started to tick up and all this sort of stuff.
The quick 30 seconds on the Carvana story is it's an online platform for selling used cars, and it went gangbusters during the pandemic, loaded up on debt, and then the pandemic unwinds and interest rates go up. And all of a sudden, used cars aren't as hot as they were. Remember, They were so hot during the pandemic. And people, it doesn't just plummet. People throw around words like bankruptcy. It's finished. Everyone on the street goes to sell. I just want to paint a picture of like how hated and how it was like basically trading at 0 and it's going bankrupt. analysts are writing, it's going bankrupt.
Mhm.
This is not a company that's going to exist. And it's in that time that you decide to kind of stick your nose into it. And I think knowing the management team was important because it's a family run business. It's not just like management
Right.
who's got like golden parachutes. It's like, no, this is their life.
Right.
They're going to turn it around.
Yeah. I mean, like just to point out the hatred though, everything you said is right. The analysts abandoned it. The kind of the thinking that I picked up on was that people concluded if any management team let their stock go from $400 to $3.50, they must be idiots. And therefore, like, why should we pay any attention to this company? It's obviously run by idiots. And so let's move on to the next thing. And they sort of drop coverage and move on. And there's a whole class of people on X or Twitter that are these, typically anonymous hedge fund bros, I call them, who, are too scared to put their names to their Twitter accounts because probably they're worried that their bosses, if they said something dumb, their bosses would object and might fire them. So they keep it anonymous, and they just sort of, and some of them have big followings, 100,000, 150,000, whatever. I call them smart idiots or smidiots because they are smart enough to know how to, articulate a basic investment thesis. But if you poke and prod, you often find that they skate at the surface on a lot of industries or a lot of companies in particular. And they know enough to crack a joke and to kind of make fun of a management team and put somebody down. But they, really don't know, in depth. And it's when you sort of start to push them, you realize they're just operating at the surface level. And so there was a lot of that going on with Carvana. There was a lot of jokes about the management team being a bunch of criminals. And the reason why was because there's a father, Ernie Garcia Sr., who made a lot of money in the 90s, but was involved in like an SNL crisis in Orange County. And he sort of pled no contest to something that came up. But because of that, the son, Ernie Garcia Jr., whose father, helped start Carvana who went to Stanford, on his own, merits and, is a smart guy. I think everybody sees that now. It was not just a Nepo baby. He got tagged as just being a criminal because of this, no contest deal that his father had. And everybody on the management team did. So I knew a couple of the people on the management team who, like, they followed me on Twitter. And there was one guy named Dan Gill who I reached out to, who was the chief product officer. And turns out he was Canadian. I didn't even know that. He's from Kingston, I think. But he'd gone to Stanford with Ernie. And so when you say it was a family-run business, I mean, yes, there was the father-son thing. But what I learned as I talked to Dan, as in the depths of this plunge from $400 to $350, was that a lot of the management team had gone to school together at Stanford. And so they were like very tight, very close. They believed in Ernie Jr., the guy who was the CEO. And I remember talking to Dan in January of 23, so just a month after its lows. And the reason I reached out to him is one thing I noticed in 22, as the stock plummeted, Ernie Jr. bought $70 million of Carvana stock on the way down from his own pocket, his own money. So he bought $50 million in March when the stock was around $50, down from 400, but down to 50. And then in June, when it was at $20, he bought another 20 million. And then it went to 350. So like, imagine that for a second. Like, and people say, oh, he's rich and his dad was rich. I don't care how rich you are.
$70 million
you don't write a check for $70 million and you don't sweat about it. And especially when it like goes down, however many percent from 50 to 350. But then what was even more curious was that this guy, Dan, chief product officer, he bought $3 million of stock in U.S. Thanksgiving 2022 at $7 a share or so. And there was another guy who bought $700,000 worth of stock. And usually you never see the kind of lower tier management team members purchase that much stock, especially after such a big plunge. It's like, I try to imagine having a conversation like that with my wife, Amber. Like, imagine like if you're on the management team, like basically 90+% of your wealth as a husband or whatever, as a spouse, is tied up in this one company, right? And you probably have financial advisors saying, you got to diversify, you got to get out of tech, you're too in tech, you're, just all Carvana, we got to get you in real estate or mining or something like this. Something, totally, that's what these advisors say. And so for him to say like, oh yeah, honey, the stock has dropped from 400 to 7, but I want to take $3 million of our after-tax money and put it more in the stock. That would, I don't know if I would have won that argument, to be honest, with my spouse. So the fact that he did, really said a lot to me that he, and when he talked about it, he said to me, listen, we got challenges. There's no question. We have some issues that we got to deal with. We got some debt covenants that we're going to, have to face in the next 6 months and so forth. We see it like fully, clearly, but we believe in each other. We believe in Ernie. We believe in the mission. We believe in the company and so forth. And when I heard that, I knew that they were going to turn it.
And it created probably generational wealth for him. The fact that he did that at such a low price point. And today there are 13 analysts who rate Carvana a buy.
Right.
And again, just a couple of years ago, that was zero. Nobody was willing to touch these things. So now let's draw some parallels to Opendoor Technologies. There's one buy on the stock, 5 sells and 5 holds. And I would say based on the price targets, they're all sells because nobody has a price target above $2 and the stock is trading at around $9. But it's interesting how convicted you were in management at Carvana and why that was part of the attraction, because I don't think that was the case with Opendoor. Back in January, you were very critical of management, and now there's management changes. But first, I just want to start, and you've probably explained this a million times, but just for new listeners on the podcast, can we first talk, what is the Opendoor business model? What do they do?
So Carvana is trying to disrupt the traditional way you buy and sell cars and the car dealer, as sort of the focal point for how you do that traditionally by going direct, very similar to how Airbnb, it is a brand now. We didn't used to think of Airbnb. We would deal with the individual B&Bs, before. Uber, we used to deal with Beck Taxi if you're in Toronto or whatever. You wouldn't, and now we deal with this like omnipresent national or international brand. And so Carvana was trying to do that for used cars. They did raise a lot of debt in order to kind of build out a national platform because they're only in the US right now. And they were encouraged by Wall Street. It wasn't just a pandemic thing. They were encouraged ever since they IPO'd in like 2016 by Wall Street to grow, and to not be profitable because interest rates, even before the pandemic, were low. So Opendoor, in a similar way, was trying to be that national brand for real estate, residential real estate transactions in the U.S.
So in a simple way, instead of a real estate agent being the middleman, you go to this platform and it matches buyers and sellers.
Yes. And the most important part is the seller. So the seller is who goes to Opendoor, and the seller seeking a bid from Opendoor for their house.
But Opendoor would buy that house.
Right.
And that's where they got into a bit of trouble.
They did, as in 2020, when interest rates went up like 450 bips in a matter of months, basically. And so there was one particular cohort where they mispriced the amount that they paid for the houses, and their whole business model is in a very short period of time, you've got to basically get it off your balance sheet by turning around and selling it. So the premise is for this business model, if you're their typical house that they're buying and selling in the US is $400,000. And so if you and I think like our house is worth $400,000, I need assurance that Opendoor is going to make a bid within that kind of range, and more importantly, I need certainty on when this deal is going to close and when money is actually going to be in my account. Because for a lot of people, like that's an important part of the equation in terms of selling their house. They don't have the luxury of just sort of putting their house up on the market for maybe 6 months, maybe eight months in some markets.
But this is not an asset-light business. When you're owning, Uber doesn't own the taxis, Airbnb does not own any of the properties.
Right.
So, and then you face a down market. And to be fair, even with interest rates kind of coming down in the US, people are not really moving, right? So there's very little transactions happening in the housing market. That still seems like a big risk, no?
Well, obviously they got caught in 2021, and so they had to take a big write down for the homes that they purchased in that one particular cohort. They existed 10 years before that, and the model worked fine. It wasn't as profitable a model as Carvana. There's obviously differences. Like a car costs less than a house. The margins on a house and flipping, or iBuying a house is typically kind of low to mid single digit gross margins versus Carvana's on cars, which is slightly higher. And the real way that Carvana makes money is on the finance and interest, not the buying and selling of the cars themselves. And so that's how they get up to like low 20% EBITDA margins. Opendoor really didn't do that. They could do that. There are some avenues they could, like mortgage and title, for example, if they sort of lop that into the iBuying itself. But they hadn't done that to this point. So yes, you're right. Like after the mortgage rates, those spiked in the US and they pretty much stayed there. Basically the whole housing market froze for a number of years. I kept waiting. I can't remember exactly how we talked about it in January, but I kept waiting for this Carvana turnaround. It never came. And there was a Canadian woman in charge, Carrie Wheeler, who went to Queen's Commerce. Who was
and you thought, great.
On paper, she looks great. She went to Goldman. She was at TPG. She seemed like this finance person, right? And what they needed to do was sort of cut costs, the way that Carvana did, and hopefully show that they could get to some sort of steady state profitability. Because a lot of, basically what happens in these sort of 100x opportunities is that you have to have a company that basically has been left for dead, but then comes back from the grave. And the way that they can come back from the grave is that they've got to prove that they have steady state profitability. Because typically they've been unprofitable for a number of years. People assume they'll never be profitable. Just like people used to talk about Uber that way. I mean, it wasn't that long ago in like 2022 or 2023 that you would still hear people say they can never, Uber will never make money on ride sharing. They'll never make money on food delivery. That was sort of, and yet they kept growing and growing nationally and internationally with volumes, even at kind of lower margins on that national brand platform. They were able to, obviously, in Uber's case and Airbnb, prove that they could reach this steady state profitability. And Carvana did as well. And that's sort of the challenge now for Opendoor.
So yeah, and that's what I want to get to. Can you elaborate on, in best case scenario, what does the Opendoor business model look like? And then as a follow-up, you've said you're not going to rest till Opendoor is $82. It's almost $9. So I'd love to know the math that gets you to $82 per share.
So my first tweet about Opendoor was back in mid-July, on July 14th at around 2 p.m. I tweeted out this argument for why, and back then Opendoor was trading at 88 cents when I first sent that tweet. I built my position in, I think, 73 cents before. The all-time low for Opendoor had been June 25th at 51 cents. So we're not even I guess we are now, like 3 months removed. And so we've gone from 51 cents to, it hit a high a week or so ago of like $10.70. So basically 20x'd in 3 months. So what did I see at when it was 88 cents though? Basically my argument for why it should get to $82 was that I thought that, they were going to pull a Carvana-like turnaround. And the one thing that you noticed about Carvana was that when they went from this like unprofitable to profitable state, they got a re-rating basically. And so, but it wasn't a re-rating of like the price earnings multiple because they had been losing money. So you can't really compare obviously like negative price earnings to like some positive price earnings. So you have to use something like price to sales, basically. And some people say, especially all the value guys, oh, you can't do that, and I don't like it, and I would never even look and touch a company that's like unprofitable. Why should I pay attention? But if you put that aside, and just look at Carvana's situation. So Carvana in the pandemic era, 2020, late 2020, when it was $400, was a 6x forward price to sales multiple. Then the interest rates jack up and the stock price drops, and they got to a low of 0.5x forward price to sales multiple in about June of 22. So 6x to 0.5x. But now, obviously, they've come all the way back.
But sales inflected, and I'm looking at the forecast for Open, and sales are expected to fall 40% in the upcoming quarter, fall 55% in the quarter after that. Like, I don't see the inflection in the estimate.
The inflection, like what you're looking at though, in terms of the next few quarters, is basically all sort of rear view mirror stuff based on Carrie, who's no longer there. She's been replaced, based on what's happened in the last, since the July 14th tweet.
Yeah.
So the world has changed. Now the former COO of Shopify is the CEO of Open because of me and because of the retail open army that has been the biggest army since Gamestop.
Let's talk.
Demanded.
I'm so glad you brought up Gamestop. Is this like Gamestop? Is it, because that hasn't super panned out for shareholders that were looking for that 20 bagger, and it gets caught up in a like a meme, which is kind of like a dirty word in investing, and people would just say Opendoor is nothing more than that.
Well, I don't know when the last time you went to GameStop was. I mean, I can't really remember. I have 2 boys, and they used to buy video games, so maybe I went there like 7 years ago when we used to buy the physical cartridges that we'd have to like shove into the Xbox or whatever it was back then. I don't think it's a good business. I mean, to me, like I have no interest in buying. Now they've become a Bitcoin treasury company, I believe. They're run by this guy who sold a online pet food store.
Ryan Cohen.
Canadian guy, but to me,
a lot of Canadians.
To me, not a very impressive track record, and yet he's sort of treated as if he's smart because he's made money, and that's the way the media typically treats rich people, like as if you're rich, you must be smart, and so if you're not rich, you're not smart, and so he's like, they're a Bitcoin treasury company, and I think they're doing card swaps or something, digital cards. So to me, it's like a zero business. Like, why would anybody want to invest in a GameStop? Why would I ever want to invest in AMC movie theaters? Or what are some of the other meme stocks? To me, meme stocks means like we got a whole new raft of meme stocks after Opendoor became popular, and I don't consider Opendoor a meme stock. So the way I call it a cult stock. A cult stock would be like Palantir, would be like Tesla in the last decade, where their retail caught it first. They believed in it. They bid it up. Wall Street poo-pooed it and said that retail was dumb and wrong. And, it's a terribly stretched valuation. Even when Palantir was trading at $5 a share, people would go on TV and complain that it was too expensive on a price to sales basis because they're just a defense contractor and they're not, they're like, how can you value a company this way? But retail was proven right. A meme stock is more of like a shooting star. It's for whatever reason, retail embraces it. It goes up. I think we got GoPro, Krispy Kreme donuts, and I don't know if American Eagle counts as well.
Yeah,
the Sydney
now
Sweeney
it does.
thing. So, but now they've all come back to earth. So like nobody cares about them anymore because there's not a real business there. Whereas I see Opendoor as an Uber, a Carvana, a durable like turnaround business.
So for people, like a lot of people are just finding out about you, this Canadian hedge fund guy, but not if you listen to the podcast first. You knew about Eric Jackson back in January. But one of the things we talked about how some of this is old hand for you. You have a history of mobilizing a retail base in stocks. And I think, how most in media, how I first heard about you was when you were doing this with Yahoo. And, that's all history. But I wanted to get a sense from you on like, do you see parallels? Like has technology, I guess, allowed you to mobilize people the way that you did? Because you were kind of a retail activist in Yahoo back in the day. And when did you know you had struck a chord? Because you talk about a lot of stocks. And I would say that when you talked about Open, you didn't really talk about it any differently than you talked about other stocks. You have conviction. When you have conviction, you have conviction. I've heard you have interviewed you a bunch of times. So when did it feel like, hey, this feels different? I'm getting people's attention.
Well, so I had talked about IREN and CIFR, and like people were like very warm to this idea of like the next Carvana. I noticed that. And then what happened is I started to get questions or tweets from people saying, hey, you used to talk about Opendoor. Whatever happened to Opendoor? Like, why don't you talk about them anymore? Do you like them still? And the truth was that, like I said to you in January, like I had sold it like, I don't know, a year ago or something like that, because I just was fed up with Carrie. Yeah. She just never turned the thing around. And so I had to go back and look at it again because I had sort of like dropped off my radar. And so this would have been, I guess, late June, beginning of July, that I started to look into it again. And I did see, there are differences. Like it's never a cookie cutter, like exactly the same situation as a Carvana. Like Carvana had this heavy insider buying. Opendoor had just the opposite. Like Carrie was dumping shares constantly in something called a 10b5-1 plan, which is just like an excuse. Like it's a plan that they have in the States where executives just say, hey, don't get mad at me. I'm selling shares because I'm registering in advance that over the next year or 18 months, I'm just going to, every 2 weeks, I'm just going to dump shares. So you can't say that I'm doing it because I have distrust in the business or something. I'm just monetizing my, like my financial advisor told me to do it. I have to get out of tech. I have to like diversify into rocks or whatever they're going to say. And so that's just an excuse and it's a canard. But that's what she was doing. The chief legal officer was like every like 2 or 3 weeks, they were just dumping more shares on retail, all while the stock is just plummeting. And like what really annoyed people was that Carrie sold some shares. I think this was in June at 56 cents. Like you really have to think that the company is going to like 21 cents if you're selling more shares at 56 or whatever it was. So I
wonder if does she still own any shares?
No, so what happened is like basically we started this revolution against her and her, like I didn't close, like I had sort of like an open mind when I first did my first tweet. And the earnings report was like 3 weeks later. And she just laid the biggest egg on that earnings call. Because I remember, there was like such momentum. There was so to answer your question, like almost within the first week, like you could feel like there was this buzz about Opendoor and people were asking me and talking to me about it. And it just felt different than IREN or CIFR or any other stock.
And so you took it a step further. You did get a new CEO. The COO of Shopify left. They poached him from Shopify to go to Opendoor. You got the founders back on the board.
Right. Keith Raboy and Eric Wu, who were like co-founders. And Keith Raboy is like very, in my mind, he's like the smartest tech guy in Silicon Valley. He wrote he's part of the PayPal mafia. He wrote the original Opendoor business plan. And he's now a venture capitalist for Coastal Ventures. And he's had, he was the COO at Square when they were growing like a weed and all this kind of stuff. So he's a super bright guy, very intimidating guy actually to talk to because he is so bright. And Eric too, like those kinds of guys, like when you talk to them, you feel like you're listening to a podcast at like 3x speed and you're like trying to keep up and like, okay, I got that. Yeah. And
how did you get in touch? Like at what point were they like going to take a call? Did you know them beforehand? Like, because you were meeting with them.
Well, I did meet with them. I mean, I hadn't met with them before. Keith followed me on X. I don't know when he started following me. At some point, like maybe he heard about me from Yahoo. I don't know. He started following me, and and I would send him an occasional DM, and him back about nothing much. I'd send him an email. I had his Gmail. I'd send him a message about something. But I didn't know him, hadn't met him. But in my heart of hearts, when I originally wrote this sort of like $82 price target, which by the way, you asked where did it come from?
Yes.
So basically when Carvana reflated, it went back to a 5X forward price to sales. So I said, well, maybe Opendoor can do the same thing. So Opendoor went from a 7X forward price to sales down to a 0.1X. So what if it goes back to a 5X, in 3 years time? It was, so by 2028. So, in order to do that calculation, you got to pull up on the Bloomberg. Okay, what are they going to do in 2029 in terms of revenues? And then you work your way back. Like, what's a 5x multiple of the 2029, revenue target? And it's right now it's a $12 billion target, which is only 0.5% of the U.S. residential real estate market. It's very low, and yet it's so high, $12 billion. That's how you get to $82 a share.
So I want to talk about, because that's math that every fund manager and investors, they're used to, and they can sit down and they can find comfort around that. But you're meeting people on social media. You're getting investment ideas from social media. You're in front of Drake's house literally daily when you're not traveling, campaigning for him to buy one stock. And like, they don't teach that in the CFA courses, right? So you are a fund manager, and the tactics that you're employing, this, our Canadian value dividend fund manager is going to look at that and say, that's not investing. This
Sure.
is basically gambling and pumping.
Mm-hmm. Yeah, no, I hear that all the time. I'm a pump and dumper. I'm a grifter. I'm not serious. It's cringe. There was a Bloomberg article that came out about me in front of Drake's house yesterday, and there was a whole litany of comments under a few tweets about it from these anon hedge fund bros, basically saying, "Can you believe this guy?" and all the rest. So yeah, it's unorthodox, but I just don't care. I guess I've gone through my own struggles with my hedge fund. A couple of years ago, at the end of 20, I had great, basically a billionaire gave me my start with, 10 years ago for EMJ Capital. This guy that I knew when I first met him, he wasn't a billionaire, but he became a billionaire. And he said, you think different, Eric. I like the way you think. He says, I don't like your activism stuff, because now I'm a rich guy and I've got a family office and I've got all these people running around managing my money. And so it might be kind of embarrassing if you launched some activist campaign against Marissa Mayer of Yahoo. And it turns out my company is doing business with her. And then some, reporter somewhere says, oh, well, if Eric said that, then maybe this guy who gave him the money thinks the same thing about her, and it becomes kind of an embarrassment. So he said, well, why don't you just do passive investing, and just find some regular, great, boring, high growth tech stocks and just get a 10x or a 100x from those. And he said, I said, well, if you're going to write that big a check for me, sure. And so that's how I got my start. And I shot the lights out for the first, 4 or 5 years that I was managing money for him. But then I had down years in 21 and 22 back to back. And he pulled his money out at the end of 22. And I just hadn't done any high level marketing for it. So it was kind of a shocker, and you're sort of I was anyway, scratching my head, well, oh my God, what am I going to do? I got a family, I got 4 kids, I got 2 dogs, how I didn't see this coming. And so those were sort of dark days for me. And I guess, Amber, it sort of gave me I just don't give a flip about, what people say.
Swear. It's a podcast.
So, the whole Drake thing was an idea from my son, so he's
involved. It's kind of like a father-son thing.
No, it's totally, I have 2 sons, one's 16. And over the summer, after I started this open campaign and it was gaining momentum and we had this open army going and people were excited. And people said, yeah, open ride or die to $82, Eric. And I was getting all these emails from all over the world. That was the other crazy thing is Opendoor only operates in the US. But I was getting emails from, every country in Europe, every country in South America, pretty much all of Asia. I was getting but then I was getting Mongolia. I was getting Iran, Antarctica. I didn't even know people were living down in Antarctica, let alone trading stocks and stuff. And so it was wild. And so, but my son, Julian said, you keep talking about how Opendoor is so great, but most people don't watch CNBC. They don't watch, Bloomberg or these channels. How are you going to communicate to them? And I thought, oh, that's a good point, Julian, and what do you think? And so we live not too far away from Drake, and everyone in Toronto, I think, knows where Drake's house is. I mean, everyone around the world now, because it's like Kendrick put his house on the Google Maps on his album cover. So anyway, he said, like, why don't you go and film a video in front of Drake's house?
Did that feel uncomfortable to you?
Well, it seemed like off the wall, kind of crazy, but like some guy had just, before Julian suggested that, some guy had like reached out to me and who was on TikTok. And I'd gotten a TikTok because I felt like, oh, I got to get on Instagram, got to get on TikTok. You got to be one of the cool kids now. And some guy said, hey, Eric, I want to do a TikTok live interview with you. I was like, what's a TikTok live? I didn't even know what that is. So I had to go to Julian. I said, is this guy legit or not? Like, is this some crazy guy? Like, should I do this, or will I, embarrass myself if I'm doing this interview with this? And he's like, quickly, like, checks his stats and everything. And he's like, no, he's good, Dad. You got to do this. So I kind of trusted him that he knows, where things are going from a social media perspective. So when he suggested that, I thought, okay, well, if he's got a point, but I thought he just meant one video, a one-off video. And I was like, okay, let's go this afternoon. You can film me and I'll go do it. And he's like, no, you got to do it like every day, every day. And he's like, yeah, like you got to have like a campaign. Like you're trying to convince Drake to buy Opendoor stock, and you're going to be there every day until he does. How
close are you, do you think, to getting him to do it? Does he know you're there?
Well, so on day 10, we went there. Like I was hoping to go with Julian like at 5 o'clock in the afternoon, and like my wife heard about it, and she was worried. I was, when I first told her, my wife, she was like, "You're going to get arrested or something." And so when I was like, "Honey, like I want to go like 5 this afternoon, like right before dinner," she's like, "We're going out for dinner. What do you just do that later? Would you just go with him?" Like, so we ended up going at like 8 o'clock at night, 8:30 at night, and so it was kind of dark. It was the first time we've been there. We noticed, by the way, he's got a Bell payphone in front of his house.
Yeah.
I don't know why. I don't know the meaning, but it turns purple at night. So we that was like the first time we'd seen that. So we're in front of this like purple Bell payphone at night, filming this video. And all of a sudden a guy comes out of the bushes, and it's, he let us finish our like video. He's very polite, but it turned out he was the head of security for Drake, as a guy named Bucky. And so we met him that night, and he's like, guys, we've been watching you on these video cameras the last 10 days in a row. You've been coming here. Like, what's this all about? You're talking about stocks out here or something? Mm-hmm. And I said, well, no, it's not stocks in general. It's just like one particular stock. It's called Opendoor. And I pulled up my Yahoo Finance like chart of Opendoor to show Bucky. And he's like, wow. And I said, yeah. And I think Bucky, like I was the guy who called Carvana. And if I'm right, I mean, this thing could 100x. And he's like, so like if I put $10,000 into this thing, like I said, well, if I'm right, that would become $1 million, Bucky. And he's just like, what? His eyes like went so wide, he just couldn't believe it. Like $1 million? Like, are you serious? And so like, he's like, I'm going to look into this. Is this on Wealth Simple and all this, like he wanted to know. So, and so I've subsequently found, so I got his number, we stayed in touch. He said, the guy you got to talk to is Future. And I said, Future? Like, what's that? What, is that a state or what? We're like, no, he's like, no, Future's a guy that's like Drake's business manager. Future the Prince is what he goes by. And but Drake's in Europe right now. He's on tour, and Future's with him. But Future handles everything like with his business dealings. And so when he comes back, I'm going to set you up with Future, and you can talk to Future about all this. So I gave him my number, and we stayed in touch. And so we've had a couple of conversations or texts or phone calls since. The Bloomberg person wanted to take my photo, so we went over there a week or so ago. And as she was like taking a photo, I got a call from Bucky, and he's like, hey, I can see you out there. Hey, Open's doing great, like, and all this kind of, we're having this kind of conversation. So we stay in touch. So I'm hopeful still that there will be some meeting, because like as of a few days ago, Drake did get back in town. So hopefully
could be a catalyst. I don't own Opendoor anymore. I bought it and then I sold it back when they were disappointing, and I just didn't get back in. But I think in this room, we've got a couple of Opendoor. My executive producer and Million, our director of photography. Are you in or out? He's out, but I think you made enough. Yeah. So you
Well,
helped.
now I like, my son tells me like all the dads in my class, now own Open and stuff. So, like
That's dangerous because if it doesn't go well,
it could work either way. But
okay, so that's the Opendoor story, and I said I'm not in it, so I'm like I'm rooting for now Jillian and you because I want good things to happen. But then you announced your next position. And a little known company called Better Home and Finance. And I really cheered you on because I already owned that one. So I was very excited. And again, shout out to the podcast because we had a guest on, Dan Lewis at Orange Capital, who said this is a company that could run out of money, but I don't think it will. And he called it the next Carvana. So there seems to be this next Carvana hunters out there, and he focused on distressed investing. So this is like his main thing is he loves broken stories. So now you're talking Better Home and Finance.
And so I met Dan.
Oh, you did?
Yeah. So like what happened is that, as you can imagine, after Open started to take off, like my DMs are filled with people that are like, hey, can you pump my bags? I've got this stock I've owned for the 3 years and it's done nothing. Can you promote it? Can you no. So obviously like you can't do that, and like, especially like, I got a guy from Quebec City every day. He's like texting me about QNX for BlackBerry. Can you please?
I feel like I know that guy.
BlackBerry, please. Yeah. And all, and I'm like, oh, I'll get to it eventually. Like I haven't had a chance to look at it. Anyway, so you get all these people. So somebody reached out to me and suggested a stock that that I knew and they thought would, they had a position in. And so they said, well, why don't you talk to this guy, Dan? Because Dan knows this stock.
Yes.
And so I said, sure. And then so I did a Zoom with Dan. He was over in London at the time. And we found out he was from Buffalo and all this stuff. And he'd been on Amber's podcast. And so we just said, that we have that in common.
Did we make this happen?
Well, I mean, I did watch his interview after I had that Zoom, to see what he said about Better. And so he said, I know you called me about this one particular company, but, and I think it's a good company, but there's this other company that I have a position in that, it is a more like a Carvana-like company. And so do you want to hear about that? And I was like, yeah, I'm all ears, Dan. And so that's how I first came to know it.
It was already running up, and so I was very happy with the performance. And then you announced, I love it. And so you have a now Midas touch on stocks, which I don't know if you're scared by or if you like it. It goes up like 80% in 2 days after you announce Better Home. Let's talk about what it does. Mortgages.
Yeah, it's mortgage origination.
Mortgage originations. Those stocks don't typically go up like 80% in 2 days.
No, so yeah, they're competing against. But the funny thing is, like, two of his competitors own NBA teams. So apparently there's some money in mortgage origination. So Dan Gilbert of Rocket Mortgage owns the Cavs. And then this other guy, Matt Ishbia, I forget the name of his firm, UWMC or something like this.
Okay.
He owns the Phoenix Suns right now. So there's money to be made. Just like I said before, like Opendoor really needs to think about like getting into mortgage and title, as to be the Carvana, like, finance and interest piece. Like that's where the sort of the money is made in a lot of these kinds of businesses, not on the actual transactions themselves, but the financing associated with them. So Better, though, is a smaller player, but it had a big boom and kind of like, leading up to the COVID, similar to Carvana, similar to Opendoor. And then they had this big bust. And the thing that most people think of, if they've ever heard of Better before, which most haven't, but if they know it, they probably know that the CEO, this guy named Vishal Garg, fired 900 people in India, on one Zoom call
during the pandemic.
In December, I think it was 2021. So basically when mortgage rates like jumped up and they killed Carvana's business and Opendoor's business, it killed Better's business. And so they went from something like a $54 billion kind of mortgage origination run rate where they get a 2.5% take rate on those originations. They went down to $5 billion from 54 to 5, pretty much overnight. And so even though Vishal was sort of portrayed as, I don't know, heartless, this sort of a capitalist, firing 900 people in one shot and so forth, sort of like anti-DEI and all that kind of political stuff that goes with it. I mean, if you think about it from a business person's perspective, like your business like goes from 54 billion to 5 billion pretty much overnight. You just don't need as many people as they had pushing paper to, basically help, fund those mortgages that they were doing. So it made sense economically, but it wasn't communicated right. Anyway, there was a kind of a taint associated with the company. It actually prevented. One of the funny things about Better is that they were a SPAC, but most SPACs happened in 2021, like before the bust. But because of all this DEI stuff and all of the, is Vishal a heartless, capitalist and all this kind of stuff, that delayed their being able to de-SPAC.
Oh, wow.
So basically there were sort of political reasons within the SEC itself that actually kind of delayed things, as well as, there was, stuff that Vishal had to go through at the board level. We're going to hire McKinsey to make sure that, nothing bad happened here and the tone at the top was proper and all this kind of stuff. So they didn't actually de-SPAC until 2023, 2 years later, when it's pretty clear that like most SPACs had died. So not surprisingly, this thing like pretty much came out of the chute and like dropped 90%, like almost immediately. And so it's sort of like bumped along at the bottom ever since.
But all the while, were they growing? Were origination, like was the business doing what it was supposed to do?
So the thing that really, got my attention when Dan talked about it with me is that he said, the Vishal's a genius, like technically though. And, despite his reputation, and they've been building like basically an AI to replace like all the people that they had to use in India before to push the paper to actually make these transactions happen in their direct to consumer business for these mortgage originations. So basically, if they came back to that 54 billion rate today, they wouldn't need those 900 people. They would just all do it by AI because of what they've built in these last 3 years. So obviously, like that's a much different business. But then the thing that was even more interesting for me once I dug a little deeper was that they actually could have done even more mortgage business in 2021 than the 54 billion in originations. It was that like the people that they were using, those like 900 people, they physically couldn't do more. Like 54 was the limit. They could have actually done 243 billion in terms of origination. So 5x the amount. Their revenues that year could have been 5x as big as they were. And so now, again, the AI system that they built, this Betsy system, they call it, could have handled it all. And so you have a business then that's been sort of left for dead, the way that Opendoor was, the way that Carvana was. It didn't take a rocket scientist, again, to realize that mortgage rates are dropping in the U.S. The economy was slowing. With every like 25 bips of drop, the volumes go up for a business like Better. There's more mortgages. There's more refinancing that happens. And
so it's a rate cut play. Like with so much torque and a lot of risk.
And as that rate cut starts to play itself out, it's a much more profitable business than it was before.
When I see a stock in my portfolio go up like 450%, don't get me wrong, I'm very excited. But I also feel a responsibility to our viewers, both young and old. Canadians, they tend to be like a little bit more conservative. They love value, dividend paying stocks. What do you say to somebody who's like, you don't want to lure people in with these kind of returns and be sanguine about the risks. It's almost like a VC style investing, what you're doing, but in the public markets. Is that how you see it? Or do you have such conviction that you're willing to go all in? I mean, it seems like you should be allocating a small part of your portfolio to this style of investing.
Well, I do agree that, I hear from people all the time on Twitter, like, I'm all in, I'm full port open, full port, Better or whatever, like, which means like 100% of their portfolio is in one stock. And obviously that's very risky and that does weigh on me. And so I'm not their financial advisor. I'm just a guy like expressing my points of view on these particular stocks. And so you do feel like a certain pressure, if people are doing that or taking too much risk, you never know like who's BSing and who's actually telling the truth. And, but of course that weighs on me. But I do agree with you, Amber, that this style of investing is kind of like a Masayoshi-san vision fund, venture within public equities type of an approach towards these kind of left for dead, forgotten about, Walking Dead type companies, or In some cases, like, we've talked about BTQ before, which is like a smaller quantum Canadian play, like an unknown company, something that's just like totally off the radar that nobody knows about. And I'm shining a spotlight on them. And then all of a sudden people say, oh, well, actually, this is a legit company. And, maybe it's worth a lot more. But I do think that, and I've started to tweet about this lately, because obviously there's this huge kind of open army and now a better army that people talk about. But I think it's bigger than just these individual stocks. Like I really have been touched by how many people in the middle class have reached out to me over these last few weeks talking about how much money they've made on Open or better, and how much they're struggling. Okay. Especially younger people, people that can't afford houses and stuff like that. And it's not just in Canada, it's in the US. But like I was just in Germany last week, and some guy who's like 31 or something, he like found out where I was speaking at a conference in Frankfurt, and he just showed up at the conference. He like bought a ticket, and then he like approached me in the hall and he said, can I please like buy you a coffee? I want to talk to you and like tell you, like I'm in tech sales for, some tech company, but I want to break into finance and I'm having a hard time, it's so hard to get ahead. I can't afford a house and all. So this is like an international situation. And I feel angry at a bunch of people. I feel angry at people like, Carrie Wheeler, who is like dumping stock at 56 cents a share. I feel angry at Wall Street, who typically says to these retail investors, you're stupid. You can't think for yourself. You need to only put your hard-earned money in your RRSP or your 401k into our ETFs, passive ETFs. You're so stupid. You should only invest in passive ETFs because we know better, and nobody can beat the market over time. So you need to pay us fees.
Yeah.
You need to pay us fees to sit in our ETFs. And that's the only way you stupid little retail trader can get ahead, because we know better. We're smart on Wall Street. And I just don't think it's true, because, I remember
the data shows that it is true. Like index investing beats the market, like is better than the average performance of hedge funds and fund managers.
Well, I'll tell you.
Even Warren Buffett will
like
say that.
2 weeks after this pod. Warren Buffett will also say, put your eggs in a few baskets, but then watch your eggs, right? He'll also say, I watched a clip this morning of like, you probably only have 20 good investment ideas in your career. So make them count. And probably like a big part of your money that you make will be from 4 of those 20 ideas. And so, and who do we look, Kevin O'Leary. Why the hell do we pay attention to Kevin O'Leary? He's had one good investment outcome in his whole career. He sold SoftKey in the 90s to some dumb company in Boston, made a bunch of money, and parlayed that into some media blitz. He's done a bunch of other things, ETFs, this and that, crypto now. I don't think any of them have made any money. Mark Cuban sold one company to Yahoo for $5.7 billion. And he was smart enough to like buy puts like on that $5.7 billion. And yet now we treat him like he's God's gift to whoever, opining about Kamala Harris, in politics and everything, because he's rich, because he was lucky, because he sold his company 2 weeks before the whole market blew up in the .com era. Had he waited, nobody would know who this guy is. And yet we treat him as if he's this like brilliant guy. One idea, okay? And yet retail can't put 3 or 5 or 10% of their portfolio into stock specific ideas like a Carvana or an Opendoor. I mean, give me a break. I mean, I think 2 or 3 weeks after we had that podcast in January, I had a leak in my house. My daughter like flooded her bathroom, and like there was water coming through the kitchen. So a painter came in, and he said, "Oh, you're Eric Jackson. I've heard you. I follow your tweets about BTQ." And we got in this conversation. The painter, okay, he knew more about like post-quantum cryptography and BTQ and why they were sort of poised to kind of continue to do well than probably I did. And the reason why is that he knew he wasn't going to get ahead in life just being a painter. And so he had to jump the queue, like jump the line, basically. And how are you going to do that? You're going to play the lottery, you're going to do sports betting, or you're going to pay some attention to the stock market and put some money in. This is the whole reason why I'm in front of Drake's house. Like today was day 41. It's like, Drake's obviously, he's got a ton of money, right? I mean, he wastes a lot of money on sports betting. Apparently, like he lost $350,000 betting on Sinner to win the U.S. Open recently. I don't get it. I mean, obviously he got some juice out of that. Like, why not take like 50% of his sports betting budget for next year? This is what I would say to his business manager, and like put it into like a real stock, like Opendoor or Better or whatever. Like, and if it 100x's and he puts in 10 million, like, come on. Like that's meaningful. Like Drake, even for a guy like Drake, who's like got all this money, like he's got to, he should be thinking of like, how do I like, everybody's doing the, clothing and, touring and making money from that. Like he should be the one that like is known for calling the 100 baggers and getting into 100 baggers. Anyway, that's what I'd say to him.
I don't know. Don't take investment advice from Drake. I feel compelled to tell the audience that.
Well, I just think like, but this is what I call it, Rising Dynasty. I think like the middle class needs to take back control and to tell Wall Street to shove it when they push this whole passive index BS on them.
I agree that people should invest. That's the reason I have this podcast that focuses on individual stocks, because I've had those conversations too with waiters who say, they were unemployed during the pandemic, and then they started watching BNN and they started getting into investing, and it did change their lives. Like I believe that investing changes lives. I got a photo here of a guy in the Bering Sea. He's an Alaska fisherman. He's a captain of a fishing vessel. He's been out on the seas already for 5 weeks, and he owns Open. And he sent me like 40-foot wave video today of him. And he's like, this job is like mind numbing, but I like thinking about Open. Do you have any other tips for me or other stocks I need to look at? And he talks about his crew that's like bought Open, on the Bering Sea. So I just think like you need to give people more credit for being smart and self-discipline, self-education. If people are encouraged to kind of investigate the stocks and listen to a podcast like this one, they're going to make some mistakes for sure, just like I have made a ton. But that's the only way you learn. And I just think at the end of my message is for those people. It's all about slugging percentage, not batting average. It's not about how many times you're right or wrong. You got to have a few big winners. That's what did it for Mark Cuban. That's what did it for Kevin O'Leary. And it can do the same for you. So on that note, when you came in January, you gave 3 stock ideas. We always ask for pro picks. And so here's a great example of the performance. BTQ, which you mentioned, is up 102% since that episode aired. Rigetti, which is quantum computing, is up 250%. And then Peloton, flat. Stand about 2%, but 2 out of 3 and a couple of doubles and triples in there is not so bad. The question, let's just do it quickly because I want to get to your new pro picks, but do you still own BTQ? Are you still bullish on it?
Yeah, I was that was one of the reasons why I was in Germany last week. I was at a conference for DeFi and BTQ.
Do you still love DeFi?
I still own it. I still own both. I mean, I think it's a slower growing business, but I think DeFi is in the midst of launching a new crypto business, which they just announced last week. And frankly, I need to better understand it myself. Like I sort of sat at a symposium and kind of listened to kind of the high level, but I want to go through the actual business model for it. And if it does what I think it can do, I think it could absolutely be a game changer for them. But yes, I own both of those stocks still.
Rigetti, quantum computing, done very well up until this point. Do you still own it?
I don't own Rigetti. So like the only quantum name I own currently is BTQ. And basically they just got uplisted to NASDAQ, and they're a much smaller market cap quantum player. Like of all the names that are listed on the NASDAQ, I think BTQ is the smallest now at like $600 or $700 million market cap. And so I just see it as having the most upside. It's got kind of, it should be like, on par with these other names. Like they have a more exciting story. They've got more revenue potential than the Rigettis of the world. But I don't think the market's caught up with it yet. And so there's still a big discount there.
Let's use Peloton as a teachable moment just because it's the only one that didn't do well. And again, because it's a lot of parallels. It's a business that's left for dead post-pandemic sort of wasteland. And it was kind of perking up around the time that you recommended it, but obviously hasn't panned out since then. Are you still in this name? And do you have any thoughts on like, why didn't that one work?
I'm not into it because I sort of had to make some choices. And as I got more interested in Opendoor and then Better, I mean, I had to you have to choose between your babies, which ones you keep and which ones you sort of say like, oh, well, I'd rather put more money, an extra dollar behind whatever Open or something. So I sold out of Peloton. I still think it's an interesting one. I mean, right now, like one of the things that we're working on from an AI team perspective is how do you differentiate between a Peloton and an Opendoor or a Carvana? If you look, a lot of them, if you lined up a bunch of those charts, like a lot of them they look like they just fell off a cliff and then they just bump along the bottom of the ocean forever. And so how do you know that one of these names is just going to suddenly break out and sort of start this, if you look at Opendoor, for example, it's kind of crazy the way the thing is just come back to life just in the last, 2-3 months and sort of suddenly shoots up. So what are some signals of that? And so we have some ideas about precursors to that breakout. And so sometimes it's a technical tell, it might be something going on with increase in volume or something. Mm-hmm. Sometimes it's more fundamentally related. And obviously swooshing from money losing to money making is a big thing. And that happened with Carvana. Hopefully, we're on that way with Opendoor. With Peloton, I mean, they're sort of modestly profitable, but they're not it's not suddenly vectored up in a much bigger level of profitability than before. I had been hoping, I think when we talked about it in January, that they were going to cut costs. They were going to show some increase in the number of their digital subscribers and prove to the world that, hey, this thing has staying power and is actually showing some, small signs of growth. Mm-hmm. It hasn't sort of met those low expectations though. And they're just sort of still modestly growing, I would say. So, I think it's still an interesting candidate for the future, but, you'd have to see more of a boost in growth.
Well, we know you can come back to names too. Let's check in with your pro picks, your best ideas. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. We've already talked about Open and Better. You're sticking with those, right. Obviously. Yep. Open price target is $82 a share. Did you give me a better price target? Do you have?
Well, Open, I think now that I know Open more, now that Keith Raboy is back on the board, it's actually a much higher target.
What is it?
I have for Open, and I'm talking 3 to 5 years out. But I think this could be a $500 stock, something like $350 billion market cap company. So that's assuming that they truly are this Uber of residential real estate.
And have you been, did you just buy it that one time and you're just riding it? Are you continuing to deploy fresh dollars?
No, well, I mean, I've had, new investors come into the fund since the good results have been happening. And so I have to put those to work. But in general, I bought a big position at the beginning and of stock and some kind of long dated options, and I've just been sitting with it.
And you haven't sold?
No, I mean, modestly, here or there, because sometimes I'll buy on margin, and then you'll come to the end of the month and you got to sort of clean some stuff up. So there has been some modest selling, or you buy some shorter dated options, and then they come to expiration and they get sold themselves into cash or whatever. But no, I haven't sold. I think what I learned from the whole Carvana experience was, you can never be some sort of mythical trader and especially with stocks that are so volatile, and you're much better off if you just sort of buy a big chunk at the beginning, and obviously you can sell later if you get it wrong, and if Kerry had stayed in control and the thing didn't look like it was going to turn around, I would have sold. but things have been playing out. So I've just been sitting on my hands with it. And,
So what about for better? It's $53 stock.
So the target there, like today, this should be a $600 stock because
where do you get that?
There's a company that just IPO'd called Figure. I don't know if you've seen it. So Mike Cagney, who's like was the founder of SoFi. He started a new company. He left SoFi, started a new company called Figure, and it's doing HELOCs and loans and more crypto stuff than better.
Yeah.
So it's it's got the crypto pixie dust on it, but it trades at 19 times forward revenues. Okay,
that's too much.
I mean, remember Carvana is like at 5x.
Yeah,
right? I'm hoping Opendoor one day gets to 5x, and so Figure's already out of the chute at 19x. Better is trading at it's kind of tough actually because so few people cover Better.
There's only one analyst.
There's no, I can't look up what the 2026 estimates are for Better. But, with some sort of looking at what they did in the last quarter and projecting, it's like 1x forward revenues. So if you say they should be trading at Figure's multiple, they should be a $626 stock today.
But they shouldn't. That's too much for a mortgage originator.
Well,
19 times sales?
So Figure's overpriced or Better's underpriced.
Don't you think?
Nobody knows, Amber. This is where like all the Canadians will agree with you, and like all the tech investors will say, "Why is this stock sitting here like trading at 1x forward revenue when it has a better AI system probably than Figure?" So
the truth might be somewhere in between, but it still looks good at 5x.
I would not be unhappy with a $400 stock price for Better. But longer term, I think it should be a $12,000 stock in a few years.
Which? Say that again?
Better should be a $12,000 stock.
$12,000?
By 2028, yes.
It's okay. It's $53.
Remember, this was like one of these SPAC deals.
I have a good memory. Like, if I'm still doing this in 2028, you have to come on.
Oh, sure. Yeah, I know. You've got it. You wrote it down on your laptop there. So
I did, yes.
Bring it up for me.
Okay. Oh gosh, I'm like wrapping my head around that. I do want to get in your other two stocks that you brought to us, and you have been mentioning them, but IREN and CIFR, they're both Bitcoin miners, and they've both already run up. I don't know if you have an insane price target for those as well, but maybe like first talk about the thesis.
So they are thought of, or they were thought of as Bitcoin miners. I would say part of the reason why they've had such a big run up lately is that people see that really they're transforming into becoming providers of AI data centers. And so they're using the profits from their Bitcoin mining to fund the growth of building out like these mega AI data centers in places like Louisiana and West Texas. And so the world needs those data centers now because like all these, Microsofts and Metas and all the hyperscalers, every quarter they're announcing a $10 billion increase in their CapEx spending to build more data centers to keep up with the level of demand for all of us who are typing into ChatGPT or whatever. And so the whole Project Stargate with Oracle and OpenAI, I mean, that's all about like trying to keep up with the demand for AI services. And there's just not enough energized data centers out there. So the thing about IREN and CIFR, and the reason why I got excited about them I built the position in May and June. I think I built my IREN position at about $9 a share, and the CIFR position was in the threes when I built it, the high threes. And so today, I think IREN is in the 40s.
40s.
And CIFR is like $11 or something like that. It was as high as like 15 or 16 a few days ago, but it's pulled back. So both of them have 3 gigawatts of these data centers that are going to be energized or lit within the next 12 months. Basically.
Do they have any partnerships with anybody?
So they CIFR just announced a modest Google investment where they bought like 5% of the company, and then they announced some other deal with another player for some of that 3 gigawatts, but neither one has really announced their big deals yet, and so it's expected to come any day, between now and the end of the year. And a lot of people think that Oracle will be heavily involved. Or Microsoft. So what's gotten attention recently is there's this company called Nebius that did a deal with Microsoft for 1 gigawatt of data centers in New Jersey. And for that, Microsoft agreed to pay Nebius $18 billion basically over the next several years, something like $3 billion a year for 6 years or so. And so people can do the math and say like, well, okay, if they're getting $3 billion a year for 1 gigawatt, then obviously CIFR and IREN should be getting 3x that for their 3 gigawatts. And you start to look at, the price of IREN and CIFR, and that's why the stocks have been ripping. But they can continue to rip. I mean, they're both, I guess they're very well positioned, much better positioned than a company like CoreWeave, which had a, popular IPO in March. But the thing about Core, and they sort of position themselves as, hey, we're a part of this AI data center future, but they actually own no data centers. They partner with, the people that actually buy the land, negotiate the power connections with the energy authorities, and build. They're
doing billions with OpenAI, but you're saying they're kind of a broker.
Essentially, yeah. Like almost middleware, software.
Yeah.
And so IREN and CIFR are sort of coming up from underneath them to kind of potentially disrupt them.
And unlike the other stocks, they're not distressed, and they do have, I know you called Wall Street a bunch of idiots, but they have coverage. Like many analysts, like 12, 13 analysts are covering both of these stocks overwhelmingly with buys.
Right, but I guess the penny has dropped with them in that, and just in the last month or two, this sort of re-rating has happened where people say, oh, I guess they're not just a Bitcoin miner, and the way we value Bitcoin miners is they go up and down with the price of Bitcoin, and even when Bitcoin is up, sometimes the miners are they're money losing, or they're doing excessive stock compensation, and so we sell their stocks, and so they haven't, as a group, haven't done great over these last few years, even when Bitcoin has recovered. But now people are saying, oh, they're not Bitcoin miners. That's just a small subset of their business. They're really these AI businesses, and the way we need to be looking at them is like how many gigawatts do they actually have in the pipeline that are going to be turned on soon, that they could do deals with a Microsoft or a Meta or whoever. And so that's now the calculus that's taking place, and IREN and CIFR are just like perfectly positioned. I think ultimately, like in 5 years, they could be 100x opportunities from my original kind of entry point. So that would be like $900 for an IREN and $300 for a CIFR. Ultimately.
Okay, I think I have to let you go. We probably talked right up until the flight. Thank you so much for joining me, Eric. This has been so fascinating. I mean, we're all watching to see what's going to happen.
Thanks for having me. It's been great. And thanks for, it's always fun to come back here and revisit all these prior price targets.
So you brought us a bottle of champagne on our first episode, which I thank you for. And we haven't opened it because I think, what did we say, Jillian? 1 million? We want to get to 1 million downloads before we
How close are we?
We'll see. We'll see how this episode does, but we should hit it by year end. And I'm going to buy you a champagne when you get to 82 on Opendoor.
Okay.
I'm keeping this up. This is just, I'm not giving
fair.
this
$82.
back. $82.
I'm getting lots of things when Open goes to $82, I'm sure.
Okay, thank you so much. That's Eric Jackson joining us. This was probably candy for your portfolio. Our next episode, you can think of as maybe more vitamins. We've got Lyle Stein talking Canadian equities. He's with Forvest. And if you've got any questions about Canadian stocks, you can email us at questions@inthemoneypod.com, or you can find us anywhere on social media @inthemoneypod. You can also go to our website and submit questions that way, www.inthemoneypod.com. We'll see you on the next episode.